Good afternoon, everyone. We are glad that you've joined us today to talk a little bit more about student loans. My name is Sarah Scruggs, and I'm the Community Engagement Specialist here at the Harvard University Employees Credit Union. Later in our presentation, Magdalia Gomez will take over. She's the Community Engagement Manager at the credit union. Although Sarah Collins couldn't be with us today, Sarah Collins is a part of employee engagement and wellness at Brigham and Women's Hospital. These presentations are put on in partnership with her office. So if you have questions about any of these presentations that we've put on or how she can help you, she does ask that you reach out to her. Again, her name is Sarah Collins, and she is in employee wellness, and she would love to hear from you. But we're going to go ahead and get started today. Starting off with a little bit about who we are at the credit union. We are Harvard's not-for-profit financial institution. We focus a lot on our community and how we can not only reinvest in the community, but also be a part of the community in new and different ways. We are just like a bank and offer everything that they do, except we do have that larger focus on our particular community because we exclusively serve Harvard and the Harvard teaching hospitals. And anyone in those teaching hospitals, like Brigham and Women's, is eligible to join as a member at the credit union. So if you are looking for a new financial institution, we would be happy to speak with you about anything related to that. And then do know that this is an ongoing series that we have with Brigham and Women's Hospital. This is the second in our three-part series for summer personal finance. Our next is a very popular topic of home buying. That will happen next Tuesday at 1 p.m., so same time. And you are able to register for that through the website huecu.org/BWH. There will also be a link sent to you via email after this presentation is over, hopefully by tomorrow evening, that has a registration link as well. So we are really excited about this, and hopefully you're able to make it to our next one as well. And this presentation is being recorded so that way you can go back and watch this. We will post it to our YouTube channel, and like I said, we will follow up with an email with all of this information in it. We do want to make sure that number one, you can hear us today, as well as use the questions feature, because although all of you are muted, we hope that this is a time where you can get your questions answered. So I ask if you could possibly look on the right-hand side or at the top navigation and see if you have a questions box or a chat feature. And if you could let us know where you're joining us from today, that would be great, so that way we know that you can hear us, number one, and number two, you know where the questions feature is. So if you can do that as I get started on our content today, that'd be wonderful. So we'll start off with steps to student loan repayment. I see that people have joined us from all over Boston area, which is wonderful. Thank you so much for letting me know. That helps me to know that you can hear me and that you know how to ask questions of us. So the steps to student loan repayment. Where do we begin? This is a big concept to speak about and talk about. So understanding is the first piece of it. There are different types of student loans. There are different things happening and going on with those student loans. So we need to understand those things first. Then going on to knowing our repayment options, researching our federal forgiveness and discharge options, and then also considering refinancing. We'll go through each of these today, and I'll start off with the understanding your student loans. And do know that we do have resources on our website if you are interested in looking more into refinancing, but we'll get to that at the very end. But what I do want to go over first, again, is understanding our student loans. So there are different types of student loans. The first type is federal. These are your direct subsidized and unsubsidized government loans, Perkins loans, or a PLUS loan. These come directly from the federal government, and you get these by filling out the FAFSA, or the Free Application for Federal Student Aid. This is normally the first type of loan you would probably take, depending on if you qualify for it, if you're able to. So federal student loans are very common. Then you have state student loans. There are some states who have these, some states do not. Not all students receive state loans. In Massachusetts, there could be some state loans from MASFA. So if you have one of those, that could be a type of student loan. And then there are private, which is anything that is not the federal government or state government. These are private loans. So even if you have one through a credit union, it is still considered a private loan, even though the credit union is a not-for-profit. It's considered a private loan because it is not the government giving you that money. And this can come, you may have a Sallie Mae, that is a very common one to have, or it could be through a university or school, or another private company. The federal direct subsidized and unsubsidized loans, they used to be previously called Stafford loans. Names have changed quite a bit in the past few years, so know that it may have been listed as something else when you were in school, and now it's called something different. But know that this federal direct subsidized and unsubsidized should still be the same. So these loans are specifically for students. So they are in the student's name, and the student is the borrower. There's no credit check required for these. And the subsidized loan is only for undergraduates. What's the difference between subsidized and unsubsidized? Well, subsidized loans do not accrue interest while a student is in school, whereas the unsubsidized loans are accruing interest beginning at the start of the loan and when that is given out. So the subsidized only available when you're an undergrad. And then there's, with the federal loans, one of the perks is that it is deferred while you're enrolled in school. So you don't have to pay it back while you're still in school, whether that be undergrad, graduate, you know, even past that as well. If you're enrolled half-time in school, then you are able to defer those loans. There's also a 6-month grace period with these loans, which means that from the time that you graduate, there are 6 months until you have to begin paying them back. This grace period is a benefit of the federal loans, and the rates are based off of when you borrowed. So the rates that you're paying, the interest rate that you're paying on your student loan is based off of when you borrowed that. And right now, all interest rates for federal loans are at 0% because of the coronavirus, and that is in place until the end of September. And so that's a huge benefit of having federal loans at this time, is that there is no interest accruing on your loans at this point. Then there are Federal Plus and Graduate Plus loans. These loans are different from the loans that we talked about previously. The most common in undergraduate is the Parent Plus loan. So it is in the parent's name that they borrow this money, and there is no grace period. So you can request deferment on this. There are some parents who defer until after their student has graduated, and then the student pays it back, but there is no official deferment. And so there also is a varying interest rate. Like we said, it depends on when the loan was taken out. Whatever that interest rate was is the interest rate for that loan. And it is from the Department of Education. So again, that's why it has the name federal in it. And there's one other loan, which is the Graduate Plus loan. So this is for graduate students, and this is in the student's name, and there is a grace period for these students because I think they're hoping that students will hopefully get a job within 6 months and be able to begin making those payments. You can find all of this information at STUDENTAID.GOV. And right now, what we really want to point out on this website is that there's a big green box here that says your payments are automatically stopped beginning March 13th of this year, lasting through September 30th. And so this is based on coronavirus and trying to take care of people through the federal government to make sure that loans aren't a burden. So you don't have to pay your loans right now if they are federal student loans. And if you had automatic payments happening, then they have stopped. And so they will begin again starting on October 1st. So that's something that you may need to build back into your budget if you have not been paying those these past few months. Private student loans. These are borrowed through private companies outside of the federal government. So these are there's a much larger variation of everything with these loans, whereas the federal government has full control over all federal loans, including the PLUS, including the Graduate PLUS. And private student loans are all controlled by private companies, banks, credit unions. And so these vary based off the lender, the interest rate, grace period, repayment terms. You may find that the interest rate is higher or slightly lower than the federal government. Right now, there are no private student loans that have a lower interest rate than the 0% that the federal government is charging right now. And the grace period, you may find that private companies don't have a grace period for students to begin repayment. You may begin repayment right when you graduate or the day you take out the loan. So you need to look at those things. And repayment terms, they may have different terms. What are some potential benefits of the private student loan? The cosigner release option. A cosigner release option is possibly after 4 years or 48 months of on-time full payments, the cosigner of a loan can be released. So if someone has paid off 4 years of those, the cosigner is no longer responsible. And there possibly could be an interest rate reduction with an auto pay. So if you sign up to have payments automatically taken out of your account every month, there could be a small interest rate reduction. You have to know the details of these. Knowing the details of your own student loans is extremely important. Hopefully, you've been on the federal student aid website and can go there to find out exactly what's on your account, what type of loans you have. If you have probably, a different amount of different loans. You may have some through the federal government, you may have some that are private. You may have a Graduate PLUS, you may have subsidized. So you need to know those things personally about your own account. So again, like I said, going into your own amounts that you owe at this point, list those out. It's good to know that detail so that you can know exactly how much you owe. A lot is in question when you don't know exactly how much you'll end up owing. Know your interest rates. Right now, like I said, federal government interest rates are at 0%, but that ends at the end of September. So just know what is the normal interest rate for this loan. Knowing the terms of your loan. So how long will you be paying this loan back? And you can pull a credit report for all your loans if you just visit STUDENTAID.GOV and see these things. Where can you pull a credit report? If you go to annualcreditreport.com, you can receive a free weekly copy from each of the 3 bureaus until April 2021. This is based on coronavirus. They want to make sure that you have access to your credit reports. Why is this important for student loans? Well, if you possibly think about refinancing in the future, you can go and look there to see, if you feel like your credit report is a good reflection of, getting that highest or lowest interest rate, excuse me. And one other thing that's important to note about looking at your credit report for your student loans is that all of your student loans should be reported to these credit bureaus. So you'll see on there if you've made all of your on-time payments, if there are any mistakes. During COVID-19, it's a good idea to go ahead and check this credit report. I recommend maybe once every month, maybe once every 3 months, to see if there have been any accidental, maybe you have federal loans and you haven't been paying them during the coronavirus since March 13th, when you've been allowed to not pay them. You want to make sure that that's reflected on your credit report and that there's not possibly a mistake. So go ahead and check through annualcreditreport.com. This is the only website that's authorized by federal law. There's not free in the name. It just says annualcreditreport.com. So know that this is what you should see when you first pull up that website. Step 2, we have to know our repayment options. Like I said, these will look very different based on the types of loans that you have. So we'll go over quite a few of them, and we'll go over some in a little more detail than others. So there are federal repayment options. There's the standard repayment option, which is what you defer to automatically. This is up to 10 years, equal monthly payments. So they take all of the loans that you have from the federal government, they figure out how you can pay them in 10 years, and that's the monthly payment. There's graduated. So a lot of people will start their careers with a lower amount of money than they will when they end it. So you have smaller payments at the beginning, and you get graduated up to larger payments throughout those 10 years. But the term is up to 10 years. And then extended. So this is available for people who have borrowed over $30,000 in federal loans. These can be given for up to 25 years. It would be pretty difficult to pay off $30,000 of student loans in only up to 10 years. So they're extending this because it is a little bit higher. Like I said, you can visit STUDENTAID.GOV for details on maybe what repayment option you are in to see exactly where you stand with these repayment options. And then there are income-driven plans, which I know I'm just out of school very recently, about 4 years ago, and I know quite a few of my friends are on income-driven plans because they know and hope that their salary will grow. But right now they need to be paying less on their student loans so that they're able to rent an apartment, to have food on the table, things of that nature. So there are quite a few federal income-driven plans. I won't go all over these all in detail. I know quite a few of my friends are on income-based repayment, which is based on your income, and the payment can only be up to 15% of your discretionary income. And so a few of these, debt can be forgiven after a certain amount of time. So if you've possibly been on one of these income-based repayment plans, there could be an opportunity for you to have your debt forgiven if you've been paying on time for 20 or 25 years. This is where we say it's so important to go onto the website and check under your account to see what you've been doing. And these are all of the different options that you'll see. This is based on $50,000 direct unsubsidized at 6.8%. So this is for a single Massachusetts resident, family size of 1. This would be their totals of how much they would be paying per month for these different types of plans. So you see that some are probably a little more attainable for someone who is making about $50,000 a year. Some are more attainable and some are definitely just not as attainable for someone at this point. And hopefully, moving forward, they're able to get their income up and able to pay these off at a higher rate. So this is just a good example of what you could possibly see. But what I really recommend, like I said, is going to STUDENTAID.GOV and being able to look through these for yourself. I think that's really probably the most important piece of the puzzle. I'm going to hand over the presentation to Migdalia Gomez, the Community Engagement Manager, and she will talk to you about the next steps in the process.
Thank you, Sarah Scruggs, and thank you everyone for joining us today. So a little bit before I get into the deferment options, I know Sarah and I are going over a lot of different information. If there's anything that we can clarify, please let us know via the chat feature. I myself have worked in higher education my entire professional career, including being a part of the Massachusetts Association of Financial Aid Administrators, working on some national financial aid committees, and have been the Director of Student Services for a four-year liberal arts school here in the Boston area. So we definitely know our student loans, and we know it can be confusing. So if there's anything we can clarify, please do let us know. So as Sarah mentioned, there are so many different repayment options that are available for federal loans. We are not going to get into the specifics of private loans in my section because of the fact, as Sarah went into, private loans really do depend on that lender. It's just like a credit card. Every credit card has its own benefits, and they may be similar to other credit card companies, but they're not exactly the same. For the federal loans, which again are those direct subsidized and unsubsidized loans, your plus loans, such as your graduate plus or your undergraduate plus that would have been borrowed under your parent would have borrowed it on your behalf, or the Perkins loans, those all give the option of having a federal deferment. So what exactly is this for federal deferment? Federal deferment is essentially a fancier way of saying you do not need to make payments during this time. Right now, your loans are essentially, your interest rates have dropped to 0% for the federal loans. It's not an official deferment, but essentially that is how it's being treated because you're not required to make payments. This is something that for those that may be going back to school is a benefit of keeping a federal loan, because with federal loans, once you go back to school, your loans, as long as you're enrolled at least half time, will default into this federal deferment, meaning no payment is required. However, if you have the ability to make payments, in some situations, it may make sense to do so. If you have the ability to make payment, but do not have emergency savings put aside, that situation, perhaps you save for an emergency and then make payments towards student loans when they're not required. But again, the benefit of the federal deferment, that payment is not required. Now, there are going to be some situations, perhaps your income is sufficient per the federal regulations, and you're not in school at least half time, but you may be unable to make payment. In the case that you're unable to make payment and you do not qualify for a deferment, you can contact your federal servicer and ask about forbearance. Now, what happens with forbearance is that while that loan is in deferment, that is accruing, the interest is not accruing. In forbearance, that interest is accruing. Forbearance is still a better option than going delinquent on your loans, which essentially means not paying. With forbearance options, private lenders will have some similar options, so it's always good to contact your lender if you're unable to make payment. Not going to get into too much of the consequences of the missed payment. You can see them here on the slide. I would say the biggest consequence for federal loans when it comes towards repayment is that the government could garnish your wages, tax refund, Social Security benefits, and other income. And I have seen this. I've seen this happen to people that we work with. I filed taxes, and I've seen people, federal refunds essentially never going to them and going straight to the federal government. So it's very important to try to avoid being delinquent on those federal government loans. Now, we're going to talk a little bit more about some other options here when it comes to federal forgiveness and discharge options. As we know, it's an election year. There's a lot of talk amongst different parties of what they're doing, and politicians, I'm going to do this, I'm going to do that. Federal loans can and have changed based off of who is in office, and this is something to keep in mind. These that you see here haven't really changed. They sort of have more or less maintained, but the next one that I will talk about, which is public service loan forgiveness, I'll give an overview of how it currently is set up, but I do want you to know that there has been talk about this possibly changing. We don't know, unfortunately, what is going to happen until usually when it happens. So keep in mind, if you have any federal loans, and because you are the position where you work at a hospital, most of your loans probably will qualify for public service loan forgiveness. If you, well, let me first tell you exactly what that is. Now, public service loan forgiveness allows you to have your qualifying payments after you've made 120 payments, and to be qualifying, this is one of those things that has changed and it's gone back and forth, but essentially to have been a qualified payment, it has to have been under one of the income-driven repayment options. Now, if you've made 120 qualifying payments and they do not need to be in order, like you could have made 100 payments and then you went back to school, then you made 20 more when you came out, so they don't have to be in 10 years period exactly. That's why sometimes it could be a little bit longer. Now, any balance that you would have afterwards would be forgiven under this program. This program has gotten a lot of attention in the media. Some people qualified, some haven't. So the reality is it probably will change in the future, hopefully to get better, but it is something to keep in mind. If you do have these federal loans, and because of working full-time for a qualifying employer such as BWH, you may qualify for this program. If you're not quite sure, I would recommend going to STUDENTAID.GOV/public service and learning a little bit more to complete. There's a employee certification form that you can complete to track how many payments that you've made that would possibly qualify. A couple of things to keep in mind. Because this is a federal program, if you were to refinance, which I'll talk about shortly, then those benefits do not carry over. So it's very important that because of where you work, you qualify. And if you have the other payments, you may qualify as well. You don't necessarily want to bring those loans over if there's a possibility that you could have them forgiven and it makes sense within your timeline. And I'll give examples as to when this might not make sense for some individuals. So I talked a little bit about refinancing, but what exactly is it? Refinancing is when you take different loans that you have and you combine them into one loan, and then the benefit to you is that you're going to have usually a lower interest rate. That's essentially why people will refinance. Refinancing is different than federal consolidation. They sound similar, and sometimes people will use the terms interchangeably, but they are essentially different. When you consolidate your federal loans, you can only consolidate your federal loans. As you saw in that example, there are subsidized, unsubsidized loans. You can have a plus loan. So under the federal government, I could technically have, let's say just for undergrad, I borrowed sub and unsub each of the 4 years that I was an undergrad. Technically, I could have borrowed 8 undergraduate federal loans. I could consolidate those 8 undergraduate federal loans that possibly had a different interest rate every year, and sometimes sub and unsub will have different interest rates depending on when you borrowed. And I can take all of those different eight loans with different interest rates, and I can combine them into one federal loan. That is essentially consolidation. The interest rate is a weighted average of all of those interest rates. Only federal loans that are under my name, I can consolidate. Then the refinancing would be if I had, let's keep those 8 federal loans. I have those 8 federal loans, and in addition, I have maybe 2 private loans that I took. I took one maybe freshman year, maybe one senior year. So I technically have 10 loans. I could take all of those loans, the federal and the private loans, and combine them into one. Again, the benefit being that typically the reason that I would do this is because my interest rate would be lower. With federal loans, you have more benefits, and there's benefits usually such as a deferment, possible public service loan forgiveness, and due to that, they tend to have a little bit of a higher interest rate. Rates have gone down significantly in the past year with the economy and such, but for the most part, they will still have a higher interest rate, the federal loans, than the private loans. And keeping in mind that the private loan would be even a not-for-profit such as us, it would still be considered a private loan because we're not the federal government. Now, when would it make sense versus when is it possibly a better idea to stay with the federal government? The first piece is to look at those federal benefits, because if you are possibly going to go back to school and need the deferment, may not make sense to go into the private loan, because a private loan when you go back to school, they may not necessarily give you the option to defer those payments. Some lenders may, most lenders typically do not. Another reason, if you are thinking of, again, public service loan forgiveness, or there's teacher loan forgiveness, if any of those could potentially be of benefit to you, it may not make sense. However, there are times that, let's say that your balance is $10,000. You know, you've been paying so far, you look at what programs you possibly could qualify for, you realize, you know what, not really going to qualify for any of these that have been mentioned. So I'm just looking to pay this off sooner versus later. Don't want to, put myself in another repayment. If you're going to do that, then that may make sense to then look for a lower rate. If you look at your balance and decide, I don't want to wait another 100 payments or 20 payments, whatever it might be, I just want to lower the interest rate and pay it off. That's usually one of the biggest reasons. I do want to point out, when it comes to public service loan forgiveness, if you consolidate your federal loans, let's say that you've made 100 payments thus far. Let's go back to our example of 8 separate loans. If you have made 100 payments on those 8 separate loans and then consolidate with the federal government, that starts the clock again, and you would have to make 120 payments. You don't have 20 remaining payments. So public service loan forgiveness has a lot of different things to consider, and you really want to check with your servicer, you want to do your research, but I just wanted to point that out because I don't want anyone to then think, oh, okay, I'm going to consolidate and accidentally lose those payments that you have made towards public service loan forgiveness. These are some general things to think about if you are thinking about refinancing. And to give you some context as to, what is a good rate? When should I refinance? Right now, the rates are fairly low across the board with most lenders because of what is happening in our economy. So I would recommend that if you borrowed any loans, and I would say probably even within anything over 6%, over 5%, you may want to look to see if you could qualify for a lower rate. Every lender is going to be different, and most of them are going to start looking at your credit score first. Like, that's going to essentially determine what interest rate may be available to you. So when you're looking on their websites, typically you're going to see the rate that is the lowest rate, and that's typically going to go to the person that has the highest credit score. And again, for us, like, our rates are about 4.50 right now, and there are some things that you could do, such as signing up for automatic payment from your checking accounts and other things that could bring the rate down to around 4%. So that's a good idea. So if you have anything over 4%, it might be worth looking to see if it makes sense for you to refinance your loans. There are different types of interest rates. There are the fixed, which does not change for the life of the loan. There are the variable rates, which will change, and variable rates aren't necessarily a bad or a good. When you're looking to borrow, you have to understand what do I need at this moment. And if you're in a situation that you, let's say, have $2,000 left, actually, let's make it a little bit higher. For $2,000, you might decide not to refinance, but let's say you have $5,000 loan at 7%, and you can refinance it down to 3 or 4%, and that's the lowest option if you go with a variable. You may end up doing that even though the rate might go up, because the amount may be manageable in a way that if it does go up, you may decide, you know what, I'm just going to accelerate payment. I'm going to pull from maybe my savings to pay this off if the rate goes higher than what I originally had. So there are situations that a variable may make sense. A hybrid loan is essentially a combination. It's fixed for a certain time period and then will become variable. Most loans will not have a prepayment penalty. So most lenders will not do this to you, but we always recommend double check, because we want you to be able to pay off your loans faster. And if you are, you should not have to pay a penalty for doing so. So as you're looking at rates and you're comparing and trying to determine, does refinancing make sense for me, see if they have any prepayment penalties. But again, most will not, especially the most known and the not-for-profits, like they usually will not. I have not seen that, but there are companies, and sometimes Massachusetts lenders not so much, but other states may have prepayment penalties. Now that we went through a good amount when it came to the student loan repayment piece, that is, why you joined us today. But student loan repayment is a part of your bigger financial picture. You're managing student loans while also managing rent, a mortgage, utility bills, family costs, such if you have children, if you have elders that you care for, if you live with a partner and share financial responsibilities. There's a lot more than just your student loans. So as you're thinking about repaying your student loans, one of the pieces that we always recommend is think about the student loans in relation to other financial goals that you have. If you're looking to buy a home, start a family, get married, or go into retirement, how does student loan impact those other financial goals that you have? One of the services that we offer that's free for all of you, you do not have to be a member to take advantage of this, and I highly encourage this, is free financial counseling through Green Path Financial Wellness. They are accredited credit counseling that will do budget counseling, they'll do credit, and they will do COVID-19 counseling for free. They do provide student loan counseling. However, there is a cost associated with that. It's $50. I would recommend try to take advantage of the free ones. The $50 one, that is your personal choice, but it's a lot of what we've gone over through today's presentation. And if you have questions about refinancing specifically, let's say with our product, you can always call us at the credit union and we can help you. But again, the free ones are the budget, credit counseling, and general COVID-19 counseling. And we will email this presentation to everyone. Most likely, you probably will get that email tomorrow. We will also, in addition to including the slides, we will also include a link for the recording so that you have that as well. And here are just a slide just to show you the benefits of refinancing and sort of what does that look like. So we just took a loan, and this, I do want to point out, this would be interest paid moving forward. And this math, I just used our calculators, HUECU.org/calculators. There are many other calculators out there as well. So whatever works for you is what I would recommend. So let's say I have a $40,000 loan, interest is at 8.5, which if you do have interest rate that high, highly encourage you to look into refinancing if it's not a federal loan and if you're not using those federal benefits. I always recommend calculating the total interest that would be paid because this is going to help you compare different options with the concrete number. You want the lowest total interest paid. Now, if you refinance and let's say that you decided, I want to pay this off in still 8.5 years, you're going to save $6,000 in interest by dropping 3%. Your monthly payment will also go down. Another option that you typically, and this is usually what is really most common, is when you refinance, you could extend your terms. So you're going to refinance, they may not offer you 8.5, most likely they'll offer you a 10-year, 15-year, a more even number repayment. Because the 10-year option here, it's going to reduce your monthly payment, but even though you're adding a year and a half, your rate is low enough that it's going to allow you to still save $4,000. I think this might be a good option for individuals that maybe need a little bit more increase into their monthly cash flow. But if you're able to still pay more than the minimum, so that $434, if you can pay $552, if you can keep up the monthly payment you had before, I didn't do the math here, but that $12,000 will probably go down to maybe like $10,000 or so. Like it's a significant decrease in interest if you can still maintain the other payment that you had. And I did include here an example of, well, what if your interest rate only goes down by 1%? Even 1%, it's going to save you, in this case, around $2,000. And I guarantee most of us can find something to do with $2,000 other than giving it to a lender in the form of interest. We have a repayment handout that essentially walks you through the different steps that we went through today. So if you're like me and prefer a little bit of a checklist to make sure that you're following all the steps, that you know how to compare your options, you can go onto our website at huecu.org/hub. And from there, You can download this handout, and we also have some other handouts as well.